Hello and welcome everybody. Doug here with thelincolnlist.com. I want to welcome you to another edition of Whiteboard Lessons. In this segment, we're going to be talking about 3 different types of stop losses that you can implement into your trading business. Before we get started, I want to say I've done a few of these whiteboards now, so if you feel there's a topic I've left out or something specific you would like me to cover, send me an email to support@thelincolnlist.com and I'll do my best to schedule that in one of our future lessons. Also, if you'd like to trade with us live each day and see how we approach the markets, visit thelincolnlist.com, click on the link that says Trade Room, and join us on a free trial. And finally, if you like this and you like what we're doing and you enjoy the educational format, support the Lincoln List by clicking on the subscribe button up top here and be a subscriber of this channel. So let's go ahead and talk about these 3 different types of stop losses. The first one that we're going to discuss is the most common, which is a hard stop, or also known as a physical stop. So what a hard stop is, of course, is once you have entered your trade and you were filled, whether you're short or long, once you have entered the trade, you immediately put a physical or a hard stop in on a location, either based on a financial risk that you're willing to accept on that trade. Maybe it's a technical risk or a fundamental risk. Whatever it is, you have determined what your risk and your potential reward is, I'm assuming, prior to taking the trade. And as soon as that trade has been filled, you put in a physical stop. Now, this is a good stop loss to use, especially for new traders, because it keeps them on the track of discipline, which we'll get to in a second. So the advantages of doing something like a hard stop is you already know the worst case scenario before you enter a trade. So when people talk about trading being risky, or is this trade a good idea or is this trade a bad idea, we've always said that there's no such thing as a bad trade if you use a stop. So that's the truth. If you have a stop and you have a certain risk that you're willing to accept, then any trade can technically be a good trade because you will not allow that trade to take you out of the game. So a physical hard stop protects people, especially those that are starting out in trading, and it keeps their losses to a minimum. Now, the drawback to using these, if you watch some of the past videos that I've done, I've often referred to the market as an algo-driven market. We do have a lot of computerized trading and algos trading in the markets today. And it's no secret, especially on a technical basis, that market makers, algos, or whatever, can say, quote unquote, run stops or see stops or know where stops are technically on a chart. So what will happen in the case is if you always use a physical stop, and if you looked at charts, you'll know what I'm talking about, you will often be stopped out of your trades, and stopped out of your trades by accident, because there are many stocks throughout the day that will appear to break important support levels only to 20 or 30 seconds later rally off an unknown support level after they've already ran those stops. So the advantages of using something like this is that you already know your max risk. The disadvantages of using something like this is that you will be stopped out a lot, and that's okay. What you will have to do if you choose to use hard stops on all of your trades is you will have to program yourself to get back into these stocks if they meet your criteria again, or let's say if you were faked out or shaked out in that trade. The second type of stop that's commonly used is the mental stop, which you're going to hear a lot of traders talk about the mental stop. And after you've been trading for a little while, I think most people with about a year or so under their belt eventually, maybe even less than that, start using a mental stop. Because of that, the algos and the wild movements or the crazy movements that you often get with stocks, a mental stop is where you will say to yourself, I will stop out if the stock reaches a certain point. That's my mental stop. Now, the good piece to that is you most likely are not going to be stopped out. You're not going to be stopped out by a tick, a flash crash, or something like that. The downside, of course, is in order for you to use something like this successfully, you will have to have a lot of discipline. And I'll give you a good example. Let's draw a chart. Let's say, I'm going to give you a couple of candlesticks. I'm not an artist here, but let's say you are a breakout. These are candlesticks, by the way. I'm doing my best here. Let's say you're going to buy this little flag breakout, okay? Does that look like a chart? That looks like a chart to everyone. And you decide, you're going to put your stop loss right down here under the nearest piece of support. So if you use the physical stop, the hard stop, that's where it would be. There's no negotiation to that. If you get hit, you get hit, and that's the end of the story. So let's say this stock, I'm just going to shift it down here. Let's say it starts to drop, and you don't have that stop, and it's now past your mental stop. You will have to get out of this trade. Because what happens a lot of times with the traders that use the mental stop, they'll say, well, it's already gone past my support. And let's say the stock drops all the way down here and say, well, it's so close to this support, I'll wait until this one right here. And that's where I'll stop. And then, of course, you can see where I'm going with this when I say discipline, is you can just keep on doing this. The stock can just keep on going down. And you're like, well, I'll wait here, I'll add here, I'll wait here. And this is where people really lose a lot of money, because you are changing your plan. Because when you got into the trade, you said, I am willing to risk X amount of dollars. And if you use a mental stop, you can still risk that amount of dollars, but you're going to have to be able to give it a little bit of flexibility, because it's just not going to hit you every time it comes down there. But the point is, and the disadvantage, or the biggest disadvantage of this, is you can easily lose discipline, not take a loss, let your ego get in the way, and then this mental stop turns into absolute disaster because you didn't put in the protection in the first place. So that's the downfall of the mental stop. The third that we're going to talk about here is a time stop, and this is something that's not discussed very often amongst traders. It's something I like to use, one of my favorite types of stops, because one of the things that really confuses traders or hinders them from crossing from one level to the next level, taking it from a back and forth trader to somebody who's consistently profitable, is when do you get out of a trade? You know, when do you know a trade's working? When do you don't know a trade working? As we've talked before in these lessons, that every trade is different. It's a case-by-case basis, and you have all these variables that are involved in the market. A time stop is, you should know after you've traded for a while, based on your strategy, how long it normally takes for you to get paid on a trade. So I'm just going to use my examples because that's all I can do. I can't vouch for other traders. So usually when I enter a trade based on one of my favorite parabolics, shorting a parabolic or something like that, I expect within a half an hour time frame that's about where 90% of all of my winners pay out within that first 30 minutes. So what that means is when I take a trade, I'm used to getting paid or finding out the result of that trade within a half an hour. Once the half an hour crosses, I get myself into a different territory. Let's say thin ice. We'll say thin ice. We're uncharted territory, because this is where the statistics of that stock working for me, or that trade working for me, diminish. So after that, my win-loss ratio maybe goes from 80% down to 60%. So the point is this: every trader knows about what their normal time frame is. So when you get into a trade, you set that time frame, whether it's 10 minutes, depending on what kind of trader you are, 10 minutes, an hour, 2 to 3 days if you're a swing trader. But you want to give this based on the analysis, or based on why you got into that trade. You are expecting that trade to work for you, and you're expecting it to do that in a certain amount of time. Once you've passed that certain amount of time, then the chances of that trade working for you are much slimmer. So that's the advantages of using something like this, is when the trade is not working, or you're just stuck and you're break even, you just cut the trade and you get rid of it. The good thing is you are very, very disciplined about using a time stop. The disadvantages, of course, is also discipline, just like a mental stop. You can allow a time stop, since it's not a hard stop that's already placed in. You can allow that to get out of control, all right? Because you don't have a physical stop. So anytime you don't have a physical stop, if you're using a mental stop, you're using a time stop, imaginary stops, I'll think about it stops, you're always going to run the risk of discipline. And they are better stops to use. That's why you'll find a lot of the pro traders use them, because they just don't want to get taken out by a small tick in the market. But in order for you to do that, you have to be disciplined, because once it gets to your stop loss, if it doesn't react the way that you want it to, you are going to have to cut it. So as we review, if you're new, I think it's a great idea to take hard stops. Make sure you're starting a very disciplined type of business, and you're training your brain to be disciplined and methodical about your trading. The second, of course, is once you get a little bit more market experience and you understand how stocks works and the fluctuations of the stocks you trade, because we've talked about it before, not every stock is equal, so sometimes your mental stop's going to be wider than it is at other times. It's based on the stock. Some stocks are very volatile. Some stocks are very smooth in the way that they're operating throughout the course of the day. So once you've learned how to do that, start using a little bit of mental stops, but understand that just because you use a mental stop doesn't mean you can just let this thing go forever, because once it starts crossing your threshold of risk, you're going to have to display that discipline to get out of the trade. And last, one of the most important, of course, is the time stop. We all know after we've traded for any length of time, we understand how our strategy pays us out. We know what to expect when we're looking at a trade. For a breakout buyer, a breakdown shorter, a parabolic shorter, makes no difference what it is. You have some sort of time frame that you're used to seeing your trades work. Once you do not get paid within those time frames, in most cases, the best thing that you can do is to cut that trade. So anyway, I want to thank everyone for attending this whiteboard or spending the time to watch it. I hope these 3 stop losses can help you kind of tidy up your business and help you make money. As I mentioned in the very beginning, at any time you need help with your trading, visit thelincolnlist.com. Take a free trial to our live trade room. Until next time, talk to you again.